I want to move on and talk about something that I'm very interested in, and that is dividend products. We get a lot of interest in this from investors. And Jeremy, I know Wisdom Tree has got a very interesting suite of dividend products, including a dividend growth ETF. You've got a mid-cap dividend ETF, a large-cap dividend, a small-cap dividend. You kind of cover the universe there. Tell us a little bit about how you weight these products and what future does dividend producers have in 2021. We're putting up here some of the specific names of Wisdom Tree products here in the dividend space. But tell us how you weight these products.
The key, on just the case, Tom brought it up earlier on, just the historically low yielding environment, rates at zero, short-term rates at zero, the TIPS yields, the inflation adjusted yields at negative rates, negative 1% plus. The Fed wants to target more than 2% inflation, and you're just getting a little bit over 1% on your 10-year. I mean, it's a tough spot for investors who need income. And so, we kind of think of dividends as things that can protect from inflation over time. They rise. If you go in the 70s and 80s, dividends grew 6%. Dividend growth was more than inflation during the high inflation decades. And we expect a return to inflation. So that's a sort of macro case. In terms of how we weight these portfolios, unlike the market cap weighted indexes, these rebalance back to dividend streams. So Apple pay $10 billion plus in dividends. You take all the total dividends in the U.S. and divide it by that total dividend stream. Last year was a tough year for, let's say you showed some of the mid and small cap dividends. Large cap dividends were only down 2-3% in aggregate. They weren't down by a lot. But when you go to that mid and small cap, they were down 20 to 25%, at the bottoms they're down even more. And so that was really the shutdown economy. The sort of mid and small caps more sensitive to the US, to the shutdown, large caps, quality, more tech, more healthcare, not as impacted with the virus. But as you get to a reopening, I mean, we're starting to see like emerging markets leading this year. You're seeing small caps leading, sort of the reopening benefiting. It started with the election and the vaccine. It's been doing well.
But Jeremy, I wonder if we could put up what's in the U.S. dividend growth, the largest holdings here. So I see Apple, I see Microsoft, Johnson & Johnson, Verizon, and Procter & Gamble. This is like, mega cap land here. Is Apple in there because why? It's growing its dividend? I mean, Apple does not strike me as a big dividend provider or even growing it. But what's the criteria here for including companies?
It is the biggest.
Like
it's basically one of the biggest dividend payers in the world. So when you take the total dividend stream it's paying, essentially the dividends per share times shares outstanding, which is sort of a modified market cap, giving more weight to the more dividends they pay. It screens for quality. The specific screens are growth and quality. I call the quality screen your Warren Buffett factor. He always says I buy like high return equity and no debt when he says like what types of companies buy. That's half of the screen is those quality factors. The other half is earnings growth, traditional Russell growth type screens. You package that together and then you weight back to the dividend stream once a year. It just did that in December. And so that higher quality nature, we think, leads to companies that can sustainably grow their earnings and dividends over time.
Tom, can I be a curmudgeon on dividends? Here's a problem I've had for years. The viewers get me a curmudgeon? No. You know me, Tom. The viewers think dividends are free. That's the problem I've got with this whole thing. They think that, if a stock is $100 and it pays out a $2 dividend, that's like $2 that's free. But it's not free. You and I know that if it pays $100 and it pays out a $2 dividend, the stock is down $98. That there is no free lunch out there. And every year we just get so many, how do I get more, dividends out of the thing? As if the dividend that you're going to get is suddenly going to cause your total amount of money that you're going to have to outperform everything else. And I don't know if that's the case or not. Or am I just being a curmudgeon on this?
You're not, Bob. I mean, everybody has to rethink income today. You think about a classic 60-40 portfolio. People are living longer. That 40% allocation, many advisors are thinking in the next 5 years might be dead money. Might be not only that you're not going to make much, but you might lose money if we start to see a little bit of a creep up in rates. As you're looking at this ETF, DGRW, and you look at the holdings, these are some of the best performers in the S&P 500 in the last 10 years. But they're fairly priced and they're kicking off decent dividends. If you're retiring at 65 today, would you rather have these types of companies in your portfolio in the next 25 years, or be exposed to the bond market where you're not making much of a yield, and in fact, that money is at risk if we do see higher rates? So we're seeing more and more of a shift to more of an allocation towards dividends.
Yeah, but that's an argument for the predominance of the quality screen, I think, rather than on the dividends. Brian, I've sort of left you out of this. I don't know if you have any thoughts on the whole dividend question, but it's a big issue. My point is that dividends are not free, and investors somehow think that I don't know why, they think that they are, but they're not. So the question is, how do you pull out money in a situation, people want to pull out money in a situation where there's not a lot of money to pull out? It makes some sense to go into high dividend payers, but there are risks with doing that. Look at ExxonMobil. We don't know if ExxonMobil's dividend is safe at all, for example.
Yeah, Bob, you're right, and I agree with what Tom was saying. What I think we're really hearing from investors is less specific on dividend and more specific around I need income. And I do think that investors are continuing to look for income in the markets, particularly because they're not so sure that the bond markets are going to be able to provide that for them. One way, obviously, you can do that is by getting option premiums, right? And so we've actually launched an actively managed ETF, JEPI, JEPI, which is essentially a covered call overlay strategy. It's got active equity underlying, but then using the option markets, we can overlay on that. And the way we think about that one is, it protects to the downside, so you're only going to get 60 to 80% of the downside. But on the upside, you can get a 6 to 8% yield off of this. And so that can really start to drive a nice income story for you. It's not a dividend per se, but that is that income that we think investors are looking for. On the other side of the table, and tying it back to the Biden administration, investors are also starting to think about, are my taxes going to creep up? And they're also seeing that there's going to be an aggressive infrastructure program. And so could municipalities benefit from this? Munis. We've got an ultra-short muni ETF, which can get you 85% of the yield, the tax equivalent yield of a 10-year treasury with only 8.5% of the duration. So I do think investors are continuing to look for income. They might not be looking in the traditional dividend bucket. They might need to look in some other areas for their portfolio.